Welcome to the Lauder Institute at the University of Pennsylvania. I'm Jules van Binsbergen, director of the Institute and a finance professor at the Wharton School.
And I'm Jonathan Berk, a finance professor at the Graduate School of Business at Stanford University. This is the All Else Equal podcast.
Welcome back, everybody. Today we're going to address an important question with perhaps a surprising answer. How rich are the Ivy League universities really? And many listeners are aware of the advertised endowments of the Ivies running in the tens of billions of dollars, like Harvard has close to 50 billion, Yale close to 40, Stanford close to 40, and MIT and Penn have close to $20 billion endowments. So it's tempting to conclude that they're very rich. But today we're going to dive into the way that universities operate, how their budgets are set, the long-term commitments that they've made, and the streams of revenue that they receive. We're going to put this in a consistent framework proposed by three authors from Harvard, John Campbell, Jeremy Stein, and Alex Wu. And once we do that, a much more nuanced picture is going to appear.
Jules, why don't we just take a step back here? Universities like Stanford and the Ivy League universities are private institutions, right?
Indeed.
They run based on private donations.
Yeah.
It's a unique model. Most other universities in the world, certainly the top ones, are public universities, and they draw on taxpayer dollars to finance them. So the first big step, the first big picture question you have to ask is, well, how big an endowment do you need to make up for all the revenues a public university gets directly from taxpayers?
Yeah, absolutely. Although I do think that, of course, there's another side of that equation, which is that we also need to think about what are the all expenditures of a private university relative to a public university. And so the financing models that these universities use, indeed, the public and the private universities use different sources of revenue to finance all of the things that they want to do. And let's be clear, private universities have made a lot of ambitions clear of things that they want to do. Let's do a couple of examples. We all know that universities will receive part of their revenue from tuition. But there is also a large discussion going on whether everybody should be paying tuition. And I think that particularly recently, and we actually spent quite an interesting episode on this before, that a lot of students that currently go to university don't pay the full tuition and actually get quite a bit of financial aid, and that financial aid really lowers the revenue that the university effectively is receiving.
Yeah, I mean, this is one of the things that I think private universities have really done a bad job on, which is accept the narrative that the tuition fees at universities have gone up enormously. That narrative is just basically incorrect. That universities are the only organizations, private universities are the only organizations I know of that can truly price discriminate. So for those listeners who don't know what I mean, if you're a monopolist and you're selling a product and you're the one who has the product, what you would like to do is charge everybody their willingness to pay for the product. Of course, in reality, you can't do that because you can't observe everybody's willingness to pay. And so you have to pick one price. Universities have pulled off the near impossible. In other words, what they do is they charge a different tuition to different entities, to different students, based on their willingness to pay. They call that financial aid. Another way of looking at it is they're letting poor people in at a lower price. Any way you want to look at it, what that means is the published tuition price, really what is the published tuition price is the maximum anybody pays, is very, very different to what people actually pay for tuition.
So let's put some concrete numbers on this. I think recently the episode that we currently are discussing, I think was nicely illustrated in a working paper by John Campbell, Jeremy Stein, and I think one of their PhD students, Wu. And I think that what they show is that the tuition fee and fees that the Faculty of Arts and Sciences at Harvard officially charges is $449 million. And the tuition discount for the fiscal year of 2023 was $303.7 million. So you can see indeed exactly the point that you just made, Jonathan, which is that the officially advertised tuition fee, and this could be both for undergraduate and graduate programs, compared to the effective revenue that the university is receiving is actually quite different. Now, what are the other sources of revenue that the university generally gets? So I think a large chunk is going to be this tuition. There's, of course, continuing education and other fees. That is a pretty big chunk for the Faculty of Arts and Sciences. And then, of course, another very large piece is going to be what's called the net endowment distribution. And so the total operating revenue that the university has already counts on being able to draw from that endowment a substantial amount of money. Just to put this in context, the net endowment distribution is $834.9 million. So that's a substantial amount compared to that tuition amount that we just mentioned.
Yeah, I mean, let's just repeat these numbers. And this is, of course, coming from this working paper looking at the Faculty of Arts and Sciences at Harvard University. But the total billed tuition, whatever that means, was on the order of $450 million. But the university only collected $145 million because $303 million went to some form of a tuition discount or financial aid. So total tuition in the Faculty of Arts and Sciences at Harvard was $145 million, whereas the endowment payout completely dwarfs the amount of collected tuition.
So this is on the operating revenue side. Let's now look at some numbers on the expenses side. So total salaries and wages is in the order of magnitude of $557 million. And now the thing, of course, is that the way that universities work is that a substantial part of those wages are actually wages that are committed, not just for this year, but for many years into the future. Why is that? Well, because the highly paid professors at universities are tenured professors, and tenured professors have a promise that they cannot be fired and that their salaries cannot be lowered. And so once you've made that commitment, a large fraction of that has to be extended into the future and projected into the future. And so in many ways, you've made promises that you will have to keep, and you need to keep on financing that outflow of money. So now, if we combine that insight with another important insight, which I think we both agree on, which is the objective of a university should be that it operates in perpetuity. Meaning, in principle, we would like the institution to function under the assumption that it will exist forever. And therefore, we want to have that we can continue operations in a particular way without having to cut much or preferably grow, and not have to shrink in terms of either the amount of faculty that we hire, the number of students that we educate. And so I think that once we combine these promises together with the mission of the university where we want to exist in perpetuity, now this idea of we've made a lot of promises for a long time into the future really starts to get bite.
Yeah. So now why don't we turn to the same paper, which was a very provocative piece. Again, focusing on the Faculty of Arts and Sciences, we should be clear. The Faculty of Arts and Sciences is probably different at Harvard to some other faculties. For example, the medical school is probably completely different funding structure. I'm pretty certain the business school works under a different funding structure. But since the paper's about the Faculty of Arts and Sciences, let's just focus on the Faculty of Arts and Sciences. And they reach this very provocative conclusion that Harvard University is actually in very dire financial shape. That if you calculate the present value of all its commitments and compare that to its assets, you get a big negative number, not a positive number. So the question really is, how did these authors reach this conclusion? Why is it that Harvard University, given its current commitments and its total value of assets, is in a negative position? And so let's go through that. The first point the authors make is the general point that GAAP accounting principles can often hide the actual value of an organization.
Indeed. And so I think that accounting principles in many ways focus people on short-term budgets where we want to make sure that in the next year or 2 or 3 years, we don't have a budgetary shortfall. You know, when we teach our finance classes, Jonathan, we make it very clear that accounting principles and finance principles are actually quite different. Here's how I always explain it to the students. Suppose we have a company and we buy a $100,000 truck for the company. The finance person says, if the $100,000 left the firm today, then we take that full hit and that is a cash outflow. The accountant says, let's pretend that it only costs $10,000 this year, and it also costs 10,000 more for the next 9 years. And so therefore we spread this out over this 10-year period. And the question is, does that give a realistic picture? And some people would say, well, given the fact that you're going to be using the truck for those 10 years, I want to just spread it out. But from a cash flow in and out perspective, it is the truth that the money left the firm today, the moment that we bought the truck.
Yeah, I agree. I mean, this is what I think is the problem with accounting. Nobody in their right mind, when they buy a car, would do that. If I go out and buy a car, even though I might drive that car for 10 years, my checking account goes down by the price of the car today. I don't sit there and say, oh, no, I can depreciate this car over 10 years.
Indeed. So why would it be any different for a company or for a university than it is for an individual doing their budgetary planning?
Yeah, so the problem is accounting was formulated before we really understood economics. I mean, that's a bold statement, but okay, that's what I think. And as such, the accounting principles are essentially not correct. And so I think that often GAAP accounting can appear to show that you're making money when in fact you're losing money because of these archaic principles that were formulated before principles of economics were formulated. I think today, if we were to start from scratch, we would no longer have these invented concepts in accounting. We would instead say, just tell us how much you earned and tell us what you paid. And we would then, from those numbers, compute the value of the firm. So what Campbell, Stein, and Wu did was they said, well, look, we know the value of the assets. So all we have to do then is project the expenses and value those expenses. And if we look at those two numbers, we can then value how the future commitments compare to the current value of the university. And that's essentially what they did. And they found a negative number. Now, of course, they had to make quite a few assumptions on the future expenses of the university.
No, indeed. But to say it differently, Jonathan, I think that the assumptions that they made essentially are consistent with the idea that suppose that the university wanted to continue on the track that it was on. And so therefore it wouldn't make major adjustments to, say, financial aid. It wouldn't majorly cut tuition. It wouldn't majorly fire faculty members, which in many cases, as we discussed, it can't to begin with. Although what you could, of course, do is hire fewer of them, fewer new ones of them. But I do think that projecting costs on the track that the university is on and then comparing that with the value of the assets is a useful exercise because it gives the board of the university a sense of, can we continue on the path that we're on? And I think that one thing that particularly is salient here is the following. If you're already, with the current value of the endowment and the projected giving that you have into the future, if you already are falling short of all of the costs and expenses that you've projected into the future, that means that even small disturbances to the inflows should actually lead to budget cuts and should impact the way that you're running the university because you're already on the edge of being sustainable in the long run. And so I think that with the recent Trump measures and other things that we're viewing, I think the universities are nervous. And I think that the press is sort of asking the question, why are these universities so nervous? Because their endowments are so large. I think that this paper gives a very good rationale that the universities better be nervous because they're already pretty much break even operating in terms of present value terms. So as soon as the inflow is disrupted in this way, either through the subsidies, the NIH subsidies, or through the charitable giving that is going down, I think the universities will have to adjust their operations. And so I think that in the last couple of weeks, we've seen many universities freeze their hiring, freeze staff, and lots of adjustments already to the way the universities are operating.
Well, you know, the big picture, I think, is the following, which is, like any organization, the university has a budget, okay? And that budget is essentially in balance. Now you tell me I'm going to cut something, you have to do a cut, right? So it doesn't take much of a change before pain is felt. Now, I think a naive view of that is to say, why bother cutting? Just spend more money out of the endowment. They've got these limitless endowments. Well, obviously, what that ignores is any money spent today is money that could be that you don't have in the future.
Yes.
So if you're looking at the university as a self-sustaining permanent organization, then you don't have the ability to spend more today because that's going to take away from your mission to be in perpetuity, because if you do that, eventually you will run out of money. Now, where I do take issue with the paper is the following, which is the assumption that the commitments the university are making today will just continue. That isn't exactly correct, because I would say that the future gift giving and the needs of the university are very tightly connected. So if gift giving goes down or you put in an endowment tax, the response of the university is actually to make these cuts. Now, of course, you may say to me, well, that's fine, Jonathan, but the people who are cut aren't going to feel great about this. Agreed. So another way of saying that is, yes, the university's mission is going to be impacted, but the idea that these things are uncoupled, I think, is the root cause of the numbers that they're getting. I guess another way of saying this, universities are probably going to continue to survive, no problem, but they are not going to survive in the way they are currently spending their money, given the fact that they are spending more than is sustainable by the endowment, even before the Trump effects.
No. So this we're in agreement on, but let's take one quick step back. The first one is, I want to make one very clear distinction, which is, you said, like many organizations, universities have a budget and the budget needs to balance. But what I really think the paper pushes people to think about is that it's the intertemporal budget constraint, meaning that we take the whole future of cash flows that we want to finance into account and not just look at and approve annual budgets 1 year by 1 year. Because I do think that that's a pretty myopic view that can actually lead you astray, particularly in the context of the accounting principles that we discussed earlier. I think 1 year budgets can actually be quite misleading. And therefore, I think that moving to a more intertemporal, long-term, even perpetuity view of the organization, I think that's a big step forward. Let's start with that. 2, I agree with you that these things are intimately linked, but I think that where the discussion is right now is that people are under the impression that the endowment serves as a buffer so that even when there are bad times, the university could operate and continue in exactly the same way as they were before. And I think that once we really look at the intertemporal budget constraint, I'm not sure how much buffer there really is. If it was the case that the assets were way bigger than the promises, then maybe there was some buffer so that you can take some hits and you can continue what you were doing before. But at this point, I think we're so tight, or even in a shortage situation, that any hits will immediately start to affect the budget. And I think that's consistent with the behavior that we see the university exhibit at this point.
Yeah, I think, as we would say in economics, it's endogenous. The reason why the budget is in balance, the reason why there isn't a huge surplus, is because the more money the endowments churn out, the more the university hires, right? They see the payout of the endowment as a form of income. And so then if the payout is reduced, they're going to have to cut. That's, I think, how universities work. I've always also felt that that way of operating a university is myopic. In other words, universities never think about investment in the way a firm might think about investment. So when a university is, say, charging tuition and they're charging less tuition, as we just saw for the Faculty of Arts and Sciences, even the advertised tuition, even if everybody was paying full tuition, that's still half the amount that they're getting from the endowment. So even at full tuition, the endowment is supporting a lot of what the university is doing. My own view is that should be thought of as an investment. If we think about the way private universities are funded, well, the implicit agreement is they educate students and they charge tuition that's less than what it costs. And in return, those students eventually give money back to the university. So if you think of it that way, you could think of the endowment expenses on students as a form of investment. And the question is, how efficient is that? Are they correctly investing in the right students?
So the question is, if we look at the way that admissions decisions are made, do you think that the admissions officers have an explicit discussion about what the expected present value of the giving of that particular student towards the future would be? And maybe indirectly they do that. And we talked about legacy admissions in the past, which in some sense takes some of that directly into account. So we did that in a previous episode. But other than that, I think you're completely right. It is an investment decision, and it's actually quite a particular investment decision. In many ways, I think it's comparable to a venture capital investment decision, which is some students will become extraordinarily successful. You don't know yet which they're going to be, and as a consequence, you invest in a large pool of extremely talented students. And if 5% of them end up giving back a lot, that finances the educational journey of thousands of other students.
And, this really gets to the mission of a university. And I actually think that nobody really wants to tackle this question because I don't think there's general agreement. I think there are many people who think the mission of the university is just to do good. So it doesn't matter what the investment returns are, right? We should just admit the poorest student, the most underprivileged student, and we don't care if that student ever gives money back. We're just doing good by educating them. And I think there are other people like me who have a more pragmatic view, which is that it's a organization we would like to last in perpetuity, and therefore there's some responsibility to make sure that that works, and that some students, if they aren't likely to give back to the university, should not be preferenced over students that are more likely to get back. And, this is not really a question of how poor or rich they are. Often the students who will give back the most are the students who came in poor, but the university enabled them to become very rich. And they're very grateful for that. I mean, I remember when the Knight Management Center at Stanford was opened and Phil Knight stood there and looked at the audience and said, if it wasn't for the Graduate School of Business, I would still be selling sneakers on the street. Here we have a case of somebody who's given an enormous amount of money to my employer who was not rich coming in. But again, I think you have to think about this as an investment.
Agreed. So let's summarize, Jonathan. So I think that the first thing that is important is that university administrators would do well starting to think more intertemporally in terms of their budget constraints rather than sticking with these accounting principles and doing 1 or 2 year budgets that they get approved. I think that if we compare the total amount of promises, if elite universities continue on the track that they're on right now, compared to the amount of assets that they have, may actually be way closer than people realize. I think that a lot of people think that Ivy League universities are in an incredibly comfortable position where their endowments are so large that essentially nothing is binding, and that therefore the value of the assets is way larger than what the value of the promises is. I think that paper by Campbell, Stein, and Wu definitely presents a relatively straightforward computation that at least raises the possibility that the promises and the assets are way closer, or maybe even that the promises are substantially larger than the assets. And so I think that that provides a rationale for why universities are cutting their budgets already 2 months into the Trump presidency, after certain subsidy flows are stopping and donors have been less generous in their giving.
Yeah, and I would actually say I go straight further, that I interpret the analysis that the authors did in the paper as saying that things are going to have to change, that the commitments the university have made, especially I would say as far as tuition discounts, they're going to have to really look carefully at that. Because if you're offering, if your posted tuition is $450 million and you're only collecting $145 million of that, that tells me there's a lot of tuition subsidies that you're giving, which is fine if you could afford it. But the question is, can you, given as large as that endowment is, those are large tuition subsidies.
Thanks for listening to the All Else Equal podcast. Please leave us a review at Apple Podcasts. We love to hear from our listeners. Also, be sure to catch our next episode by subscribing or following our show wherever you listen to your podcasts. For more information and episodes, visit allelseequalpodcast.com or follow us on LinkedIn. The All Else Equal podcast is a joint production of Stanford University's Graduate School of Business and the Lauder Institute at the University of Pennsylvania. It is produced by University FM.